Right, welcome to the show. We're half an hour away from the opening bell. Shanghai and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks extending gains from that two-year high ahead of that US CPI print, even as Fed Chair Jay Powell repeats that higher for longer mantra.
Chinese equities, though, may struggle for momentum, at least following mixed results from big tech. Tencent beating expectations, but Alibaba reporting a sharp drop in profits.
Plus, Beijing blasting the U.S. move to hike tariffs on about $18 billion of imports as President Biden accuses China of cheating on trade. We're seeing a little bit of a spillover here from these U.S. markets that was really kind of tech-driven here, and you're seeing very closely the Asian stocks are catching a slight bid here this morning. This is, of course, ahead of that ever-crucial U.S. CPI print here. We're expecting a slowness of these price pressures here, perhaps the first time in 6 months or so. So if we see that, does this lead to more upside in equities is still the key question. How is the two-year yield going to react more to? Is it going to be an upside surprise or an actual big miss here? So certainly that's what we're dealing with. 41 for your two-year yield right now. We're watching that 10-year yield as well. Keep in mind, PPI prices overnight did rise. So certainly that is maybe an indication of what's to come. And we're watching very closely these JGBs here this morning and watching will we ever get to that 10-year or decade highs in that 10-year JGB. We're at about 0.95 right now. 20 years already reaching those levels here, but unchanged here at the moment. Keep in mind, Hong Kong, South Korea also closed here today. And we're watching very closely what goes on when it comes to these oil markets. There was a bit of a drop overnight. We're recovering a little bit here today, but it really is about this China tech story as well. The tale of these two tech giants, right? So we saw profit plunge or earnings plunge in Alibaba. Tencent, though, you're starting to see signs that they're able to generate some revenue and margins on some of these new businesses. Online video ads was really that sweet spot there. That's why you're seeing these ADRs react this way. Hong Kong's closed today, so we're not going to see that reaction. We might have to wait till Thursday for that. But take a look at how the setup is when it comes to this approach to the open in China. We're still a little bit on the back foot here when it comes to A50 futures. 229 for your Chinese 10-year yield. We do have that one-year MLF coming up. Set to hold, Dave, but it's getting to be a kind of close call, right? After that, those bad credit numbers that we saw in April as well. 724 for the currency.
It seems to be a matter of really when, not if.
Yeah.
Certainly when you look at the swaps numbers coming through, you know, the one-year swaps tied to the 7-day repo is actually now at the lowest since 2020. In fact, we'll talk more about that in a moment. So in terms of the agenda today, so these new tariffs, well, increased tariffs in some sectors like EVs, new tariffs on things like syringes, for example. That's your market iteration of this geopolitical agenda today. The one-year MLF, as Yvonne was talking about, there is coming out in about 17 minutes from now. Markets are shut, so liquidity volumes will remain thin. You don't have the stock connect as well today. You have an imminent bullish cross on the CSI 300. That is mainly a function of math at this point in time. Given the momentum coming through recently, we are in the window for some FDI numbers coming through as well. All that being said, we're also looking at some reaction as far as MSCI. They came out with their changes to the benchmark effective at the end of the month. More on that in a moment there. More on the MLF. As Yvonne is pointing out, there we're already at, what, 2.5%? Which is just about the lowest here since, I think, this specific benchmark was introduced a few years back. So 2.5%, no change, although you are getting some corners of this market expecting maybe some tweak, maybe some net injection. Let's keep an eye on this as well. Now, we talked about swaps, right? So here's the measure for you. It's actually now dipped below the low in 2023 and 2022. So at 187, sorry to get so geeky this early. That takes us all the way back to 2020. But yeah, this really goes into the weakness in the economy. We can get to a bit later on, of course.
That's right. Let's get to our top story here this morning. China has blasted the Biden administration's move in a statement vowing to take its own action, but has yet to reveal any concrete response to those tariffs. Our chief North Asia correspondent, Stephen Engel, joins us now for more. We knew this was coming, but what stood out to you?
Yeah, so I'll get to China's response in just a sec. Let's just run through what the Biden administration is actually doing, because we had that scoop late last week, and it's pretty much come to fruition now with the Biden administration announcing that the year will be tariff increases on Chinese EVs, semiconductors, solar cells, of course, lithium-ion batteries. Interestingly, just lithium-ion batteries for EVs, not necessarily for solar cells and wind power. I'll get to that and the reasons why in just a second as well. But also potentially critical minerals, and the list is quite long as well. Syringes and needles, 50%, surgical gloves, ship-to-shore cranes. That's an interesting one, 25% increase of those. Those are those giant cranes that you see in harbors, obviously, that take the containers off the ships onto shore. I see them all the time in Seattle. They actually ship them across the Pacific on a ship, and you can see the whole crane come into town. But again, the Biden administration in February launched an investigation into potential national security threats because companies like Shanghai Zhenhua Heavy Industry is a big player there. They have ties to the Communist Party, so you can kind of connect the dots. Again, Janet Yellen and others have said these particular tariffs are targeted at particular sectors that either have allegations of illegal subsidies or potential dumping or are national security threats. So again, Yellen, though, did also come out with a statement saying, because the concern is if you're going to be raising all these tariffs on products that Americans use, I mean, EVs is a different one. There's not a lot of Chinese EVs in America. But again, it could potentially have an inflationary effect. She says there will not be meaningful rise in U.S. prices. And on EVs, she also says that over time, U.S. prices on EVs will start coming down. But again, a quick way to lower inflation on the automobile industry would be to import those sub $10,000 EVs from BYD.
Yeah.
Doesn't look like it's going to happen because tariffs are going to go up by more than 100% on Chinese EVs. I mentioned about solar cells.
Yeah.
Because this was a 2-year review process, right? So they looked at all the different impacts that would have on industries. And the solar industry is trying to build out its own robustness, if you will, in the United States, its own supply chain. But that industry says we need the equipment. We need to import that. So please don't necessarily tariff 25, 50, 100% on certain equipment, gear for solar cells and solar modules and the like solar ingot, wafer making equipment and the like. So again, the United States Trade Representative's Office, USTR, and Catherine Tai essentially saying they're going to open up a process of reviewing certain products in the solar industry, including 19 products for gear, and that those will be under review for not getting increases. And right now, there's no increases on them.
And we're flashing the response out of Beijing, and unsurprisingly, they're not happy. The devil will be in the details here and how they respond.
Yeah.
Do we have any idea what that might look like?
Well, you would assume that they might go with their own restrictions on critical minerals that go into new tech, green tech products. We simply don't know. We have one comment from Michael Herson, a former U.S. Treasury official who now leads China analysis at 22V Research. He says the Chinese retaliation at U.S. companies, they could retaliate against U.S. companies, or if they ramp up those supply chain restrictions like limiting exports of critical minerals, quote, would hurt Xi's efforts, Xi Jinping, to shore up domestic and international confidence in China. Anyway, so we'll be waiting. They did put out a statement saying China will take resolute measures to safeguard its own rights and interests. The U.S. should immediately correct its actions, wrong actions, it says, and correct the additional measures, cancel the additional measures against China. They call it political manipulation ahead of the election in November.
Steve, thank you. Stephen Engel there, our Chief North Asia correspondent, getting us up to speed here on these tariffs. Again, just keep in mind, Hong Kong markets are closed, so any potential reaction will maybe be in onshore markets. The reason I say that, too, is you had the big earnings coming through, and all Hong Kong listed, of course, Tencent and Alibaba. Tencent steady overnight, Alibaba big drop there. Look at earnings coming through here. And I guess a tale of the two tech giants, if you'll, revenue, operating profit, and net income coming through. Numbers on your screens. So we're looking at 220, this is billion revenue for Alibaba, all the way down the income statement, takes you to 18 billion. Tencent, as you can see, is a 50 billion net income renminbi company on your screen. There we go.
Yeah, so it's a lot, but basically it showed Alibaba still faltering a bit here. Tencent, though, with a better than expected, really upside surprise when it came to where profit came through. For more, let's bring in Bloomberg's managing editor for Asia Technology, Edwin Shen. Also want to thank and bring in our senior APAC consumer analyst, Catherine Lim from Bloomberg Intelligence. She's still in town for us. I'll start with you, Edwin. It seems like we're seeing a Tencent that is coming back from this pandemic and coming out stronger now.
A little bit. I think there are two sides to this coin. Yes, we saw profit surge 62%. So that was solid, a robust performance. And I think the market initially liked what it saw, but let's bear in mind that there are some longer-term endemic issues. I think Tencent's still struggling to fill its games pipeline, for instance. I think it still needs to find an answer to ByteDance. We saw video accounts gain some traction in the March quarter, which is clearly a sign of initial success against its arch rival. But it does need to find a longer-term answer for Douyin, I think.
Catherine, I'll bring you in. Alibaba arguably facing a fiercer competitive dynamic, if you will, in some of their segments. Just your takeaways from their earnings.
Right. So I guess we're shifting gears now to the e-commerce side of things. And we're talking about China e-commerce and global e-commerce. So this is where it gets very tricky for Alibaba because they are facing competitors on mainland, and we're talking about PDD, JD.com, Douyin as well. And then overseas, here comes Shein, TikTok, and Amazon. Well, that's a whole slew of competition that Alibaba is facing, and that's the profit decline that we're actually seeing.
What about that jump in cloud profit? How sustainable is that?
Well, I guess, given that the company have indicated that they're going to invest more into the AI research and development, and clearly, we've seen some of the price-cutting moves that they have taken increasingly into April as well. I don't think that, we're going to see that profit lift from cloud over the next 3 quarters, at least through calendar 2024. They are out to actually revive the top-line growth for the cloud business. And the company has a goal to actually get into the double-digit cloud revenue growth by the second half of fiscal 2025.
Edwin, I'll bring you in. Generally speaking, since we're talking about cloud, I mean, these big tech giants are facing competition, stiff competition from the state players here.
Yeah, so we're seeing, as Catherine well knows, Alibaba has lost quite a bit of market share over the past few years for various reasons. Some of them are attributable to the political environment, but I think Alibaba also failed to capitalize on its dominance a few years ago in the cloud. At one point it was, by some measures, the world's 3rd largest cloud service, just behind AWS and Microsoft. That is clearly not the case now. I think Joe Tsai and Eddie Wu, they have said cloud is one of their twin foci, along with e-commerce, and I think they do have they are resolved to claw their way back. But we'll have to see. Regionally, as Catherine mentioned, competition beyond China can be a little tricky, especially since as a Chinese company, they may not have access, for instance, to the high-end semiconductors they may need to underpin a truly competitive cloud service. So I think the jury's out on the cloud, but I'd love to hear what Catherine says about that.
Yeah, maybe chime in.
Yeah.
Right. I guess, that is the million-dollar question, because clearly we haven't actually seen a lot of the breakthroughs from the company, let alone, I guess, as what Edwin has mentioned, there looks like, there can be geographical barriers as well, and, how embracing some of these geographies can be to what Alibaba has to offer remains a question mark. I think they have actually also cut the international prices for their cloud businesses as well. I think that is about 2 months ago. So we'll actually have to see whether the overseas enterprises take that on.
Right. Guys, thank you so much. Catherine Lim here, of course, with us, and also Edwin Chan on all things big tech. By the way, coming up, we'll be furthering our discussion on this. We'll be joined by UBP in the next hour of the China Show. Vey-Sern Ling will be joining us to give us his take on these earnings.
Yeah, Bloomberg alum himself joining us here from Bloomberg Intelligence. But taking a look when it comes to Hang Seng Bank, Dan Wang telling us that how China's ultra-long bond sales will replenish capital for domestic banks and infrastructure building, but may also crowd out private businesses. We're going to ask her why. We're counting down the open of trade in Shanghai and Shenzhen. Hong Kong markets are shut. We have that MLF in just about 6 minutes' time. This is the China Show. All right, we're going to wait for that MLF in just a couple minutes' time here. Your fix just crossing the Bloomberg as well on the bottom of your screens this morning. Let's bring in Dan Wang, Chief Economist at Hang Seng Bank China, to talk us through what to expect today from this one-year MLF. And Dan, it's interesting. On one hand, I see the concern with the currency and why they can't cut, but then those April credit data, does show that they need some sort of stimulus here right now. How close of a call is this really going to be?
Well, our forecast right now is to keep the status quo, no rate cuts, because the short-term stimulus will prove to be quite ineffective. Businesses and consumers are not really in the mood of borrowing from commercial banks, and they need to stabilize the housing market a bit further. So the ultra-long-term bond issuance might be more of a solution from the central bank rather than the short-term rate cuts.
Right. Okay. So that takes us into the special sovereign bond operation, and I think they're raising the first batch of that money on Friday. Well, they've told us about that already, so I would imagine that's mostly in these forecasts. But what sectors do you think that's going to benefit the most?
Well, the simple answer is the state sector or the government-affiliated privately owned enterprises that specialize in some sort of construction or equipment. So overall, this kind of bond issuance will finance long-term infrastructure, especially when it comes to the digital infrastructure or something related with the disaster alleviation. But in the short term, it just seems that a lot of those projects have problem of getting the initial funds ready. And many people can see that this type of bond issuance also cause a lot more volatility in the bond market, and because all the banks will rush in to buy those bonds since there's a lack of alternative investment vehicles.
Where does that leave the private sector then?
Well, I can see a strong momentum of crowding out of the private sector investment. And the reason for that is quite simple, because most of those projects will only be contracted out to the SOEs or centrally owned enterprises or those large POEs. And for small private businesses, they already have a hard time to guarantee the financing from commercial banks because the collateral value in their hand are declining with the declining of the housing sector. So I don't think there is a true incentive from the central government to bail out the small private business at this point. They will only guarantee the largest business in China to thrive because they align with the national strategy of the emerging industries.
So what then would be potential solutions to get private sector demand up and running? And also, are you seeing any early signs that private sector demand is actually starting to turn as well?
Well, there are some signs in the services sector. We can see that this year, the Chinese people spend way more on higher quality services in like pharmaceutical, medical services, tourism, transportation, and things like that. But overall, the consumer sentiment is still muted. I think the ultimate solution is still how China can boost its domestic demand. And right now, it seems the easiest, in my opinion, the only solution is to do some sort of income boost for the low-income families, basically cash transfer, maybe through the digital currency, maybe through some government subsidies. But there are no other ways besides really directly boosting the housing sector that can turn the Chinese sentiment around.
All right, and we just got that breaking news, Dan Wang. No change when it comes to that MLF. So they're keeping that 1 year at 2.5%. They're offering 125 billion yuan MLF, which is what has been due in April. So we're seeing a little bit of a movement in the currency, not a whole lot here today. But, Dan Wang, is it getting harder, though, to push back against the speculation on cuts here right now? I mean, are we, you mentioned about the housing sector, we have to see a bit of recovery there first, but is there still room for cuts in the back half of this year?
I think there's plenty of room for more rate cuts, but the willingness to adopt this kind of policy is quite low. There's a high emphasis on stabilizing Chinese currency in order to guarantee a relatively healthy performance of China's export sector. That has long-term consequences, though, because Chinese government really want to protect the domestic banks, and that's another reason why they're unwilling to cut rates. But if there are no general rate cuts, then the burden of debt payments would be quite high. Unless they can find some alternative ways to blow up the inflation. At this point, maybe the price control or the price regulation is the only way. But that means over time, the debts accumulated in SOEs and in the government would also be much higher than what we see now.
Right, and I feel, Dan, since you brought it up, we ask you the same question on inflation every time, and you give us the same answer. There is no inflation in sight. I'll try again, though. What's your outlook for inflation this year?
Sometimes people talk about the trade-off between short-term and long-term when it comes to inflation. I somehow believe that this low inflation or negative inflation environment can be a permanent phenomenon. We can clearly see this credit decline, and that is a long-term trend. It's not a short-term monetary contraction. It's a long-term trend. And that means we will see more of a liquidity problem for some of the sectors affected, especially housing. And unless somehow the overseas market open its door more to China, including the European market or Belt and Road countries, otherwise I can see actually more difficulties for China to implement its economic recovery plans.
Dan Wang, thank you so much, as always, for the insights. Chief economist there at Hang Seng Bank China, joining us out of Shanghai. Brief look at futures right now going into the open on the Chinese mainland today. We're shut here in Hong Kong. Futures are pointing lower, slightly stronger on the currency, and we're being extremely generous with that description. Plenty more ahead. This is Bloomberg. Right, so welcome back to the China Show. Just, under 4 minutes away from the opening bell onshore. And you know what? There's really not much happening in these markets today. Well, for one, Hong Kong and Korea are closed.
It feels like a holiday.
It does feel like a holiday. Just look outside the window. The perfect holiday weather. What are we doing with our life indoors on a day like today?
All right.
We have jobs to do, though.
There's still some analyst actions out there. Neo ADR is raised to neutral at JP Morgan with a price target of 540. San Heavy Industries raised to buy at Citi. And Wanda Film rated a new strong buy at China Merchants.
Right. The opening bell just over 3 minutes away. Maybe we'll see something happen. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down the open of markets in Greater China. Well, I should only say onshore markets here, with Hong Kong shut for Buddha's birthday here today. So it feels like things are pretty slow going at the start of things. We're seeing pretty much flat markets. Currency not really budging too much, even after that one-year MLF was unchanged here this morning. We did have those earnings coming through from Tencent and Alibaba. Certainly ADRs move, but we're not going to see any reaction until really Thursday, Dave, here in Hong Kong.
Yeah, especially for Alibaba, right? The 6% drop overnight in the U.S. We'll have to wait 24 hours for that, as Yvonne is pointing out, though. Even on the currency, just to add to what Yvonne said, so MLF, no change there. No reaction to the tariffs taking place. In fact, when you look at implied, it's also indicating that there might not actually be any reaction in the event that, I guess it depends on what and how China responds in kind to those new tariffs that were announced yesterday. In fact, some of the new ones, for example, 50% tariffs from 0 to 50% on those specific products, bottom of your screen. So we're looking at some of these PPE suppliers, for example, medical equipment stocks, for example. So we're up to 25% on medical PPE. Weakness coming through. I would imagine there's no volume coming through. The other big story, relatively big story on a quiet day, are changes to some of the benchmarks. MSCI out with this sort of whole list. These are the companies they're removing. Over 50 companies out of MSCI China. The previous board you saw were the additions to 10. So apart from that, we are, I guess, waiting to see how these equity markets trade. US CPI, of course, comes out later today. That's probably the big one as well. All that being said, though, the the fact that we're trading at about 2-year highs on the regional benchmark, I guess, says a lot about just the risk appetite out there, despite inflation, Yvonne, remaining. And sticking its ugly head out again. Yeah, I mean, the bad smell.
You had the likes of Nvidia was up massively even before the CPI report. These meme stocks are going nuts again for a second day.
So certainly,
there is appetite still to buy stocks here right now. Is that still the case in China? Let's bring in our Asia stocks reporter Ishika Mukherjee joining us out of Singapore. Ishika, I mean, there was no change in that MLF. Things are pretty quiet here today. What do you make of the reaction so far?
Yeah, like you said, Yvonne, there's not much reaction in the markets. The markets in China, onshore at least, don't tend to react too much to MLF. I think if they would have cut, that would have been a big move, considering that we saw new credit shrink for the first time since 2005 from the data that was released over the weekend. I guess where the markets are right now in terms of valuations, all these concerns in terms of, the credit impulse in the economy or the yuan, where the yuan's at, all of that has been priced in to a large extent. And you're really seeing more of a momentum trade in the onshore China markets, which JP Morgan thinks, based on historical analysis going back to 1995, can actually continue, and the CSI 300 could potentially go 20% upwards from here. They, however, feel like the offshore market is done in terms of the tactical bounce without a meaningful shift in policy. And I guess the MLF being held at where it is just another indication that the PBOC is a bit wary to move right now as they're watching the currency levels.
Okay, maybe we can talk about earnings this time. Maybe something else to talk about, something more to talk about as far as that's concerned. So Alibaba came out 10 cents out. How important were these set of earnings? Put this into the sort of big picture context for us.
Sure. So, yeah, like the other news, which is the tariffs, of course, is not impacting the market, not seen to impact the market too much at all. So earnings of Tencent and Alibaba are really the thing that traders are looking at today. You're seeing a big divergence there, even in stock performance between Tencent and Alibaba. Tencent even overshot the Magnificent Seven at one point already earlier this year, whereas Alibaba is sort of struggling. Both earnings, though, while Tencent has seen a profit surge versus Alibaba's big decline in net income, both earnings don't say much about the broader economy at this point yet. It's very company-specific factors. So Tencent is more about WeChat and demand for videos on it, and cost cuts as well. So it's not really saying anything about the broader Chinese economy or any improvement in consumption, which is really what everyone's watching for to see if the Chinese economy can recover in a sustainable way from here.
Yeah, we've talked to a lot of guests that are talking about positioning and are these long-only funds really coming back in a big way? How do you see these global funds, and what are they thinking about when it comes to China right now?
Yeah, not really. There's not a lot of excitement or optimism out there. Remember that these global long-only funds have been massively underweight China. The lowest weights in many years, if not record lows. So them coming back at this point, any jump that you're seeing in the market is much more of a tactical move where they want to profit a bit from the sentiment or the momentum in the market. No one is saying that fundamentals are really recovering and this is the time to, get to come back in a big way and move your underweight back to a neutral or even an overweight in China. Of course, you have strategists calling for an overweight in China, but in terms of the fund managers themselves, especially those managing global big mandates, there's really not much optimism on the China rally yet. But everyone thinks this is a tactical rebound that needs to be matched by earnings recovery, because that's what matters at the end of the day, which we haven't seen yet.
Ishika, thank you, Ishika Mukherjee there, our Asia stocks reporter joining us out of Singapore. And speaking of which, we're talking to one of those big foreign investors as well, like the likes of Franklin Templeton. The investment CEO, Jenny Johnson, is saying that Chinese manufacturers have figured out how to skirt U.S. trade tariffs. Speaking to us exclusively at the Qatar Economic Forum, she says the world's second biggest economy can weather the blow from tougher trade restrictions.
There's been a lot of pain, obviously, in the Chinese market. You've seen it with where the equity markets went. again, it's the second largest economy in the world. They've been very focused on growing their domestic economy. And that therefore creates opportunities. We've had a joint venture in China for over 20 years with local investment people on the ground. When you're in a local market, you can understand where there's growth and where there isn't growth, and that creates investment opportunities. And I think the thing that we've seen with China is when the government of China wants to do something, and they have indicated that it's important that they have a robust market, they can provide the kind of incentives and catalysts to do that. So, we think China has gone through a lot of pain, but there's still opportunity in segments of China.
Have you seen the worst in Chinese property market?
So the Chinese property market's interesting. Again, where there's pain, there can be opportunity. I was talking to somebody who says the wealth channel in China, that families who have lost money in the property market are realizing they need to have a diversified portfolio. So they're just starting to diversify out of some of their real estate into other parts. Again, as a manager with investment teams on the ground, that's a great opportunity for us.
Of course, we're all keeping an eye on that U.S. election. If we have a Trump 2.0, Jenny, would it change all the assumptions you're making right now about investing in China? Because we saw how the Trump administration caused a lot of pain. We saw how the yuan slumped during his administration.
What I think that potentially could be underestimated is the entrepreneur's ability to figure out how to navigate these kind of environments. And in speaking to folks in Hong Kong and who handle supply chains and others, there are a lot of mid-sized companies in China who have figured out that they can set up their last stage of manufacturing in Vietnam and Indonesia, Malaysia, and just assemble enough to meet, say, the WTO requirements, and then it's stamped made in Vietnam, for example, and then it gets imported into the U.S. and bypasses those tariffs. So, look, there's no question that there's a shifting of supply chain that's going on that naturally has to happen, but I don't think it kills the Chinese economies. I don't think a Trump administration necessarily is going to do that.
I know.
There you go. Jenny Johnson, the boss at Franklin Templeton, speaking with, of course, Haslinda exclusively at our conference that's taking place over in Doha. Right. So they were touching on the tariffs the tariff conversation and certainly the announcement yesterday. Not much was new. We knew they were coming. I guess to some extent there were new categories from 0 to 50%, of course, in some. That means that the question right now is, are we seeing any reaction in the currency markets? The short answer is no. As you can see, the currency has been in a weakening bias, but a lot of this might have to do with the fact that the dollar has also picked up. Inflation is coming out later today. Consumer price inflation, PPI overnight did give us something to think about too, ahead of inflation coming. In fact, I could replace dollar China with dollar yen. It would look almost exactly the same visually at this chart. Right. In terms of expected vol, for example. So we're looking at a 1 week measure here. And as you can see, this takes a look at this over the course of 30 days or 30 trading sessions to be more specific. Nothing much has changed. It's remained stable. The spike, in case you're curious what that is, that's actually when the suspected intervention took place with the yen, rocking FX markets. But to answer the question again, no, that's been stable. It remains stable up to this point in time. One thing to watch, though, and again, we're hat tip to Tanya Chen, of course, our FX and rates reporter, for flagging this, is the spread between the offshore and the onshore rate. That tends to diverge when you get sort of periods of sort of one-sided, favored one-sided trade, for example, speculation that the currency is going to weaken. That tends to go the opposite way. That's, as you can see, also remained quite behaved as well. So nothing of the sort that you're seeing here. And again, that's just 90 seconds of saying no, there really hasn't been any reaction in the currency market so far.
Yeah, you're just milking the time here. Right now.
Well, that's what we do have to do sometimes.
Short answer is no. But I think it's interesting, right? They say the threat of tariffs might not be shown, but U.S. politics and how this November election is going to play out is certainly something longer term that is playing out across these currency markets as well. All right. Great charts there. Coming up next, we're talking a bit more about Russia's Vladimir Putin, set to visit key ally China as Beijing faces U.S. pressure over its support for Moscow. We have plenty more coming up. This is Bloomberg. All right, mainland markets are doing this here on this Wednesday morning, and we're still seeing stocks a little bit on the back foot here this morning. The CSI 300 is down about 0.5%. Same goes to the Shanghai Composite. We're still well above that 3,100 level, though, and property seems to be still catching a slight bid here this morning, Dave.
Yeah, and we're looking ahead to the weekend, well, at least the next 2 days before the weekend, because there's a big event taking place in China. Confirmed yesterday, Russian President Vladimir Putin is set for a visit to China for 2 days starting tomorrow. His visit does come, of course, as Beijing faces growing pressure over its support for Moscow amid the war in Ukraine. Let's bring in James Mager, our China economy editor, to talk us through this. And James, there was also an interview that the Russian president did with Xinhua, which I guess we can get to in a moment. What would be on the agenda these next 2 days? Let's start there.
I think the main thing is that Russia wants to sort of firm up its Chinese support for its economy. One of the things, obviously, is they want to try and sell more oil and gas. So they're trying to increase their ability to sell gas, especially through a new pipeline, which the Chinese have been sort of resisting signing the deal for this new pipeline. So according to our reporting, there's no expectation that deal is going to be signed. But Russia does need to sell the gas that it produces to somewhere, and obviously it can't sell it to Europe anymore. And so China is really the only customer for that. The second thing is that they want to ensure that Chinese companies still continue to sell them the goods they need to both for their industrial economy, but also for military production. And the US has been putting increasing pressure on, and the Europeans as well, have been putting increasing pressure on China to stop selling dual-use goods that are then being used in Russian weapons. And so the US is now threatening secondary sanctions on banks, meaning Chinese banks. And I guess the Russians are probably going to want to sort of make sure that doesn't happen. Or if that does happen, they're still able to get the supplies that they need from China.
James, the fact that the Russian president chose China as his first overseas trip after securing a fifth term, what does that tell you? I mean, where are we on this kind of no limits partnership right now?
I mean, I think he's visiting East Asia generally. The reporting is he's also going to North Korea, and he may go to Vietnam. Those aren't confirmed yet, but we're expecting an announcement today from TASS and KCNA that he's probably going to North Korea as well. But I think these visits show how limited, the limited number of places that he can actually go without being arrested or without, where he's welcome to go. Obviously he's not going to be arrested on the International Criminal Court warrant in China and North Korea. But there's a lot of places in the world where he cannot go. He cannot show that he has support. And so, if he wants to, discuss things that are important to their economy, if he wants to show that Russia is not completely isolated in the world, these are probably some of the only countries that he could actually visit.
James, thank you, James Mager, there with a preview of what to expect when Putin does step down in China as well. And ahead of that visit, Chinese state media Xinhua, as you mentioned, posted an interview with Putin. We'll have the details of that later on in our China brief.
Right. Now, let's stay in politics. Results of India's national elections are due early next month, with Narendra Modi seeking to extend his decade in power by another 5 years. The Prime Minister is both highly popular and also deeply polarizing. Bloomberg Originals has been looking into his rise at the very top of Indian politics.
Who is Narendra Modi? Well, it depends on who you ask.
India's Prime Minister makes the impossible possible.
He is very conscious of his image in history.
He has completely seduced the Hindu belt.
Some view him as the most effective Prime Minister in the history of India. He's passionately worshipped by millions and hailed as one of the world's most popular leaders, with approval ratings surpassing 70%.
Democracy delivers, and democracy empowers.
On the other hand, critics see him as an autocratic Hindu nationalist who marginalizes minorities and undermines democratic norms.
The idea that India is a democracy, this is a lie.
All right, for more on why Indian Prime Minister Narendra Modi is highly popular as well as deeply polarizing, as you heard in that preview there, you can read Bloomberg's Big Take today. Watch also the Bloomberg Originals documentary, or Big Take Asia podcast, also launches today on iHeartRadio, Apple Podcasts, and Spotify. New episodes will drop every Wednesday, and you can track the latest developments in India's ongoing general election on the Bloomberg Terminal and TV. That's quite a promo there. Lots to do. Again, plenty more ahead. This is Bloomberg.
ChinaAMC says it remains optimistic about inflows into its ETFs and other products, and the company says the impact of recent fee cuts are also being offset by strong business growth. The CEO, Ling, spoke exclusively to us at our event in Doha.
In the past several years, I think, well, because of the, a really bearish market and very pessimistic mood in China, so seeing a lot of pressure on the fees. Actually, we cut 30 BPs of fees off our equity fund last year. And I think that's something the whole industry is trying to adapt. At the same time, we certainly see that, fee cut has been the trend for the global industry as a whole. So this is not really surprising in any sense, but it just happened to be coinciding with this cycle of the business.
How is it impacting ChinaAMC in particular?
For ChinaAMC, we were, in a way, I think we cannot say being lucky, but we were, I think, keeping that impact to a minimum because we have very diversified products. So in the past year and even in this year, we have seen the largest asset growth in our company. I think we probably is the largest in the whole industry. So even though equity part, we have been, suffering from the fee cut, we have REITs, one of the largest REIT providers in China. We are the largest ETF providers in China. And also we have, other side of the business also growing, I think, pretty healthily. So it wasn't really that big fee hike for us.
That was the ChinaAMC CEO, Ling, there speaking exclusively with Has. All right, we're taking a look at some of these movements in stocks, if any, here today, MSCI China. So there's been some additions as well as deletions here today to take note of here today.
Quite a lot.
So we're talking about 10. And then 56 that are now not on that index as well. So what's worth noting to you?
Yeah, so on the addition side, so clearly there's a net deletion on MSCI China, right? So CITIC Pacific A shares are added. You have Nanjing Iron, those are A shares as well. Hisense Home Appliances are being added, and also CNOOC Energy Tech. Those are on the plus side. Deletions, I guess we'll see tomorrow because Air China is part of that. A lot of these big property developers, so Country Garden Holdings, Greenland Holdings are coming out as well. Dongfeng Motor 8 shares, which is the car maker, has also been deleted, among many other things. Sandy Heavy is also being taken out as well. So it's, I guess it's a smaller index too,
Yeah, all right. That's interesting, this kind of shakeup here. We'll see if there's any sort of reaction tomorrow. Another check of the markets here today. So it's just slow. If you take a look at, we're waiting for that US CPI print. We've been waiting for all week now, basically, and we're still seeing onshore equities facing a little bit of pressure here, despite the fact that, you are seeing some movement in some of these equity markets. Taiwan's still doing quite well here today. And you're watching very closely what goes on with, of course, some of these big names like CATL, not even reacting really to this confirmation that we're seeing in terms of tariffs from the U.S. So right now, some of these big sort of cap names are slightly to the downside. Medea Group's down some 3% here today. Ping An Insurance slightly to the downside, close to 1% losses there. And iron ore also in Dalian seeing a bit of slowness. Large caps not doing much. There's a little bit downside when it comes to some of these small caps as well. Yeah. What else are you seeing?
Well, the momentum has really gone away in the onshore market. So we were flat. I think we were flat at the start of the week. Tuesday was something similar. Today, obviously, we don't have the turnover coming through the stock connects as well. So just keep that in mind. The other thing I'd like to mention, and maybe it's because of that too, maybe these inflation numbers coming through tonight, and you know what, US PPI overnight came in above even the highest estimates, might be giving us something to think about ahead of US CPI. later today.
Yeah.
That's today, right? Yes, it's
Wednesday.
Wednesday.
It is today.
Yeah.
So it's not like there's nothing going on. There's still something that we need to kind of fear for. I think, take a look at what people are pricing in, options and the like, saying that there could be a 1% move either direction, the S&P, once we do get that inflation print here today. There you go. The TAIEX is up about 1%, which is quite interesting as well. The dollar is slightly weaker against most Asia FX here today. Also, we're watching very closely these JGBs. So there you go. That 30-year yield is up another 2 basis points here right now. We're already at those decade highs on the long end of the curve.
Yep, and we're very close in the 10-year. And do I smell a hot headline? 2 basis points to the upside. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. It's really just the onshore markets we're focused on today, with Hong Kong shut for Buddha's birthday. It looks like we're off some of the lows, but yeah, it's slow. It's slow, guys, here today. We still have those Tencent and Alibaba earnings to kind of get through here today as well. So Vey-Sern, Ling, UVP, joining us in just a few minutes.
Yeah, to unpack that, really, there seems to be we'll get to that in a moment. I was just going to say there seems to be really a clear divergence in the growth visibility of the growth path for both companies, right?
You see it in the stocks, too.
Oh, yeah. Like, I think Tencent's outperformed Baba by, over 15 percentage points this year. Year to date. The other big mover we're tracking right now, this is in the onshore market. So Guolian Securities is up by the daily limit. I think we have that stock coming up as well. This is on the back, and trading has resumed in the stock here after the company disclosed this buyout proposal from Minsheng Securities. Now, on top of that, there's also a plan to raise 2 billion renminbi in a share private placement in the event, of course, that transaction does go through. Okay, that's part of the transaction. So we're watching this closely. Apart from other things, a lot of other movers are taking place in Japan, where we are also in the thick of earnings season. More on that this hour, and really big moves in the likes of Sony. That takes us into the broader market story here. So you have two markets, fairly major markets shut, of course, Hong Kong and South Korea for Buddha's birthday. We're now trading at 180 on the MSCI Asia Pacific, which is enough actually to take us back to the highest level here in about 25 months. So early April of 2022, last time we were at about 180 on the regional benchmark. Japan is trading 0.4 to 1%. We were talking about how Taiwan has really outperformed today. 1.2%, that's the fourth tile, top row. Bottom row, we're looking at the bond markets, more in the 10-year yield at the moment in Japan, because 96.96 gets us very close to the 2023 highs in the Japanese 10-year yield. Now, many market themes that we're tracking today, so we'll talk about inflation in a moment, but certainly things like geopolitics, really, I guess in many ways, becoming really tangible the last 24 hours or so, with tariffs getting announced and the new rates on many of these product categories outside of EVs, which we were expecting.
Yeah, so the 100% tariffs we were expecting, I think it's the stuff on critical minerals, batteries, all those sorts of things that are needed in that whole supply chain when it comes to EVs or even renewable energy. Just goes to show this is beyond just an EV story, right? This is a clean tech sort of trade war that seems to be bubbling here right now between the U.S. and China.
Yeah, I think we also heard from Janet Yellen, who was speaking with PBS. And by the way, those are a look at the new and the old. That she does not expect, or at least does expect, any effect to U.S. inflation to be minimal from these tariffs taking place. I'd call your attention, too, to ship-to-shore cranes, which Stephen Engel pointed out earlier, and also syringes and needles. That come actually from 0. We're all the way up to 50%. The Ministry of Commerce has responded. They're not happy, unsurprisingly so. We've yet to see what the details are in terms of the response.
Yeah, it seems like, for most of the political scientists we've talked to say it might be quite moderate, just right now, because just given how targeted these measures are, and there still isn't one Chinese EV that is in the U.S., right? So it's not like there's a big impact in terms of the trade side of things. Yeah. So maybe we might see more in terms of targeted sort of retaliation possibly here, but so far it's really just what we're hearing from that statement as of now. You take a look at what we're tracking is those Tencent and Baba earnings. The fact that these two, both report the same day, it just, I'm sure all the analysts were up all night trying to come up with something to write in their reports here this morning, but it really shows this divergence of these two tech giants. One that is still going through a transition, it seems. I'm talking about Alibaba and Tencent, coming out of this pandemic a little bit better.
Yeah, with more visibility on the pipeline, certainly margins improved quite a bit, which is the also standard for Tencent. Alibaba reminding us, really, these earnings reminding us that this years-long transition, there's new management in place. It's going to take time to really show up in the earnings. Plus, of course, they took some one-offs because of some equity holdings that they took, which is why I think we saw an 86% drop in net income there. More on that in a moment with Vey-Sern Ling to help us unpack that story. The other big story is Jay Powell. He was speaking in between the release of the PPI numbers, which came in well above forecasts, and ahead of the other one, which comes out today.
The big one, the US CPI. So he suggested the Fed is set to keep rates higher for longer while waiting for further evidence that inflation is continuing to cool. Of course, this is just hours before that print. Take a listen.
I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work.
For more, let's bring in our Bloomberg MI strategist, Mark Cranfield. Mark, we're expecting probably one of the lowest prints for inflation out of the U.S. In a year, or this year. I'm just wondering, I'm seeing equity markets in the U.S. are still near those record highs. Treasury yields actually declined leading up to this print here as well. It seems like the market's quite sanguine about it.
They certainly would like a benign number. That would suit everybody. If you get a number which is close to forecast, maybe even a fraction below, then the bond market can be very relaxed about it. They will know that it gives them a chance for some kind of interest rate cut before the end of the year. Of course, the equity market would like it as well because they've already priced into their range for this year. The interest rates are going to come down modestly, and already you're seeing that there's decent traction, particularly in the tech sector in the US, so they would enjoy that as well. And then it would also take some of the steam out of the US dollar, so it would bring it down slightly, particularly against emerging market currencies, which are clearly under strain because of the extended strength for the US dollar. So overall, a benign outcome would certainly be what most people in the investing world would like to see. But as we've seen from the past two CPI reports, that's not necessarily the case. We expected, particularly the one that was reported in March, that was supposed to be a fairly easy number, and of course it wasn't. It was too hot, and then that was repeated by another hot one in April. You can see what happened there, particularly the bond and the currency market. They really had a huge reaction to those. So probably people don't want to get too carried away, but certainly the best outcome, a Goldilocks type outcome, would be an inline number and no revisions, or at least no upward revisions to the previous numbers.
Yeah, well, the question of the day is how far will U.S. stocks rally post-CPI? I guess it depends on the premise, right, what the print looks like. Mark, I'll make you pick between the other top two themes that we've been sort of arguing about and debating here, which one was perhaps more pronounced. There's a tech earnings theme in China, and certainly the question there is, are earnings coming through enough to justify the rally? The other thing is this melt up in JGB yields. What did you pick? What's more important for global investors at this point?
I think the one that potentially would cause the most disruption would be the melt up in Japanese yields, because the Bank of Japan is going to be the only major central bank who will be hiking interest rates in the second half of this year. Everybody else will be either starting to cut rates, or they'll be looking for their first rate cuts. We've already seen a couple, of course. Swiss National Bank and Sweden has gone already. But more importantly, probably the Bank of England and the European Central Bank are getting very close to lowering interest rates. And in contrast, you're going to have the Bank of Japan, who's actually going to be increasing again. We're not sure when. It could be July, could be more than once in the second half of the year. So clearly, you've suddenly awakened this huge Japanese bond market, which has been in the background for such a long time. Suddenly, it becomes a potential headwind for everybody. So even though we might be getting into a situation where the Federal Reserve is getting more comfortable that they could lower interest rates later in the year, investors still need to take account that you're going to have this Japanese factor where they are the second largest bond market in the G10 space, and their yields are going to be rising in conflict with the rest of the world. That is not a small matter for the bond markets, and also could have a big impact on foreign exchange as well, because eventually it will put support under the Japanese yen. There's not much sign of it yet, but we will reach a point where short-term Japanese yields will rally to the point where they're starting to erode that difference with the US, and that will play into the yen as well. So certainly currency and bond markets are in for a very lively second half of the year if Bank of Japan is able to raise rates again.
Mark, thank you. Mark Cranfield in Singapore for us. So the other story we didn't touch on, and good we have it coming up right now, is the China tech story. So Tencent reported bigger than expected surge in earnings. It's the opposite for Alibaba, where profit actually fell. The results will highlight this divergence between China's two internet pioneers, if you think about it. Let's bring in Vey-Sern Ling, Managing Director at UBP. Vey-Sern, why don't we start with, let's start with Alibaba. Why not? Get us excited about this, which looks fairly, I guess, depressing if you think about where this company's actually come from.
Yeah, I think the key for the results yesterday, I think, is that the margins actually came off across business lines. The top line growth slightly above expectations, but it shows, right, that with the new management in place, they are trying to invest more to drive growth in the company. And I think that's going to be a theme for the coming quarters, which brings about a certain level of uncertainty because you don't know how far they can reignite the growth, right, so to speak, with their spending. But having said that, I mean, the company is, well, we know valuations are depressed. They've got plenty of cash. They're hiking shareholder returns. They're giving more dividends. They're doing share buybacks. They're going to be included potentially in the Stock Connect program in September. So there are plenty of catalysts to support the share price and limit the downside while waiting for that growth to rebound, right?
Yeah, I mean, I compare it to what we saw, right, where online videos is really what was the sweet spot for this company, where you're starting to see competition maybe not as fierce. Can we say then, Vey-Sern, that e-commerce in the Chinese tech industry is still where you're going to see the most competition?
Yeah, I think that's a good point. E-commerce is definitely where there's a lot of competition because we have the likes of JD, PDD, VIP Shop, even ByteDance selling goods online. But I think if you take a step back and really compare the two companies, what it really comes down to is the core value proposition and differentiation that these companies provide, right? For Tencent, it is ultimately a social media network. The WeChat is indispensable to the everyday lives of Chinese users. And Tencent is able to build whatever monetization it wants around that core group of users because the users will never leave. While Alibaba is essentially a platform that sells goods online, and the real differentiators are the range of products, what prices you sell at. And you can argue that Alibaba has much lower barriers to entry than what Tencent is doing, which is, I think, the fundamental reason why there is a divergence now.
Should we even treat the two in the same boat? Should we put them in the same basket, Vey-Sern? I mean, both companies at their peak were trading above 30 times earnings. I think Tencent was valued above 900 billion, if I'm not mistaken. Alibaba was about 800 billion or something. In other words, can you see a path back for both to that? Or is that simply only now maybe a Tencent story more than a Baba story?
Yeah, Tencent is firing on all cylinders for sure. Margins are improving and ad growth is strong. Online games is probably going to rebound in second quarter. But having said that, you know, given how far the share price has lagged for Alibaba, and it's trading at probably half the multiples that Tencent is trading at. And in the past couple of weeks, we've seen some sort of a tactical rally in the Chinese markets. So yeah, I mean, you can't rule out inflows into Alibaba in a tactical rally. The rising tide lifts all boats, right? So, but having said that, I think the preference really is for me is Tencent because of its stronger fundamentals and core business.
Yeah, you mentioned the gaming segment, which, I mean, the numbers on the headlines still look a little bit weak. What gives you confidence in the second quarter things could look better? Because they've been still waiting for these new blockbuster hits to really kind of lift their sales.
Yeah, so the revenue that's actually recognized in the first quarter is not based on the games or the virtual items that they actually sell in the first quarter, right? It's based on what they sold previously. But if you look at the actual cash receipts that they received in the first quarter, it's actually jumped substantially. The international games is up 34% year on year. It's driven by resurgence in Supercell games, in particular Brawl Star. The domestic game receipt is up 3% year on year. So if you look at the actual recognized numbers, they are actually flat. So with cash receipts rising in the first quarter, some of that will translate into revenue recognition in the second and third quarter. And in addition to that, they're also launching some of their key games in the pipeline, like Dungeon and Fighter Mobile in the second quarter. So that's probably going to lift the online game segment growth going forward.
And on the buyback front, or let me just maybe general term, maybe shareholder returns on both stocks. So do you think that narrative continues, and has that effectively put a floor underneath these both share prices here versus Vey-Sern?
Yeah, I think it's a theme that will continue. A lot of these companies have a lot of cash, and they are also generating a lot of free cash flow. And given the environment, it's a little bit harder for them to utilize that cash for M&A. So the next most logical thing to do with it is to return it to shareholders. And also, I think the government is encouraging the companies in China to actually improve their corporate governance and be friendlier to shareholders, and buybacks and dividends are one way to do it. So it's good that you mentioned that, because if you look at Alibaba's total returns last year, $12.5 billion in buybacks and $4 billion in dividends, that comes up to almost 8% return, which is fairly decent, if not quite pretty awesome. And Tencent has been buying back shares consistently. I think the key is to watch whether they'll continue doing so, given that share price has actually rebounded quite substantially since the beginning of the year.
Yeah.
Quite pretty awesome. I love that.
Yeah, pretty awesome. All right, Vey-Sern, you're pretty awesome. Thanks for joining us again. Vey-Sern Ling there, Managing Director at UBP, joining us out of Singapore. Still ahead, we're staying on earnings, and we got the mega banks in Japan that are set to report today. We'll get an idea of what to look out for next.
Plus, we're live to Singapore as a new Prime Minister prepares to take power. And of course, Avril Hong is there for us. Avril, what's up? What's going on?
Yeah, David, this is a leadership transition that's been years in the making, and it's coming at a rather inconvenient time. Think about the external backdrop. It's not just about the US and China. As Singapore continues punching above its weight, what is this going to mean about how it balances relations with its neighbors? Domestically, housing affordability, that's dominating the conversation as well. We see how resale public flats, the prices have just gone up for 16 straight months. $1 million homes grabbing headlines. Yeah, this is a leader that is no stranger to the housing ministry portfolio. What will he bring through the table with his premiership? Those conversations up ahead. Keep it here with us. This is Bloomberg.
We're seeing very, very strong momentum. I think there's real appetite for a Japanese wealth management company. In the short run, we've got a $35 billion target. It's an ambitious target, but I actually have very little doubt that we will succeed.
Christopher Wilcox there, Executive Officer and Head of Wholesale at Nomura, speaking to us a little bit earlier about the company's outlook. And of course, it is a big day for Japanese financials, with Sumitomo Mitsui, Mizuho, and Mitsubishi UFJ all set to report results today. Let's get a preview with Bloomberg's Gareth Allen in Tokyo. And Gareth, it's interesting what we were just talking in the break about. It's a good time to be a Japanese bank these days. What are we expecting?
Yeah, that's absolutely right. And I don't think banks in Japan have had it better for as long as certainly recent memory goes. When the Bank of Japan finally gave them reprieve when they reversed negative interest rates, which has been squeezing their margins for years. So finally they have this opportunity to raise their rates. Deposit rates have already, since the Bank of Japan announced this change earlier, deposit rates have already started to come up, loan rates have already started to come up. That gives banks better chance to earn margins. It means they can make money again, and that's looking like it's what it's going to happen. So it's the full year earnings this afternoon. So we'll get, first and foremost, we'll get a new full year net income forecast, and that according to most analyst views, is going to be record levels. We're also looking for buybacks this afternoon. Mitsubishi UFJ and Sumitomo 2 are both expected to announce some quite sizable buybacks. Mizuho probably not this quarter. It's probably later in the year for them, but we'll be watching for that as well. We'll also be watching for what happened in the previous year. All three banks are set to have, they will forecast record profits, but they've probably made record profits this year as well. Mizuho had already achieved its full-year target as of quarter three, so it might be on track to beat its 2014 record profit, which is about 680 billion yen. May have got that. If the other two come in online, they'll also have made record profits for the year. So it's all looking pretty rosy for Japanese banks, and we'll be watching closely to see just how good that is.
And not to be a party pooper here, but are there any specific risks to watch out for, particularly when they come out with their guidance, Gareth?
Yeah, I mean, the risks are always there. Certainly, we'll be watching to see if there's any rise in credit costs. Obviously, the yen is putting pressure on businesses. So, potentially for a rise in credit costs there. But I think at the moment, the real environment for banks is just making money now. The environment is really good. They're going to be making money on their lending businesses. Fee businesses have been strong as well. We saw with the brokerages, they look pretty good as well in their investment banking businesses. So yeah, I think basically buybacks, new forecasts are the things to watch for, and we'll be closely monitoring that this afternoon.
There we go. Lots of good things to follow and track coming out today, next few hours. Gareth Allen, thank you so much, our breaking news editor here. Speaking of earnings, buybacks are a big theme here. So you have the likes of Sony, for example, as you can see, up about 10% stock split there. Nexon also came out with earnings. Let me just get you the headlines as far as that's concerned. That's also a beat as far as that is concerned. We're also looking at the opposite as it pertains to Sharp. You have full-year profits trailing estimates, and Rakuten first quarter loss, operating loss here, 33 billion yen. That was about 3 billion wider than estimates. Plenty more ahead. This is Bloomberg. Here's some corporate stories we're tracking today. BYD says it's still awaiting the Chilean government's approval here for the development of a lithium cathode production facility. Now, the company is denying reports from Reuters that the project has been postponed. Chile has, last year at least, granted BYD access to preferential prices for lithium carbonate, which is a key component for EV batteries. Now, still with BYD, it has debuted its first plug-in hybrid pickup truck in Mexico, to be more specific. The Chinese EV giant says the Shark will be available globally in a price from around $53,000, that's US dollars. The launch came as President Biden announced a 100% tariff, or new tariff, or increased tariffs on Chinese EVs, but BYD does not plan to sell the Shark in the U.S. for now.
All right, and we're taking a look at when it comes to that Japanese lunch break that we're heading into, and we're still seeing a slight bit when it comes to equities here this morning. We talk about these Japanese banks set to report here as well, and plenty of movement on the back of earnings as well. 156.46. We talk about this yield pickup in the JGBs not translating to yen yet. We're still watching very closely where that 10-year yield hits that 10-year high. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Live picture there. We're about 10:30 in the morning in Singapore, where I'm just looking at the weather, current weather right now. Excessive heat warning, 30 degrees, 80% humidity, so it seems like a typical day in Singapore. Leadership transition, of course, is a big story there on the ground. Markets are down 0.5%. That takes us into the broader read across these markets, where the benchmark is actually going the opposite way as Singapore, but volumes are light. No markets trading in Hong Kong and also in South Korea. We have the key inflation print coming out of the U.S. later today.
Yep. Well, of course, it's a big day. Singapore's Prime Minister Lee Hsien Loong will step down after 2 decades in office, and taking his place is 51-year-old Wang, who's set to face a growing list of economic and geopolitical challenges. Let's bring in April Hong. She joins us now live from Singapore to tell us, it's Singapore's fourth leader in 60 years. Just tell us a bit more about the change of guard and what sort of challenges and priorities are ahead for Lawrence Wang.
Yeah, this is a rare transition of power we're seeing in the Lion City, but it's also one that's been very well telegraphed. This is years in the making. We know how the Prime Minister had planned to step down at the age of 70. He's now 72. This is a stepping down that was delayed by the pandemic. And for his successor, there are challenges that abound, not just in the external backdrop where you think about the US-China relationship, but also domestically related to housing policies as well as the real estate market. So we have with us now Alan Cheong, Savills Executive Director and Research and Consultancy Head, for a chat. Alan, great to have you with us. Let's start off talking about housing affordability. I think you think that this is something that affects quite a small part of the population, but it's dominating conversations, especially when you look at how resale prices, they've been climbing for 16 straight months. We hear about all these $1 million public flats. How much pressure are they under to tackle this?
To be honest, I believe that the housing affordability issue has been studied and analyzed to death for 3 decades or so. Housing, as in public housing, if you buy from the government, a BTO, built-to-order flat, it is affordable. The problem is that it gets outsized attention about resale flats, which is a different category, and that where foreign money, as in permanent residents, and also the rest of the market that's not capped by income, can participate in that. And so that's where we have this issue. And that's where, again, we don't have a linear kind of relationship between what the problem is and what sort of attention it is getting. So it will be an issue for the incoming Prime Minister, but I believe that to focus too much and too much resources being thrown at this, looking after the lower income, which I think they are already quite well taken care of, may divert resources from the middle and upper middle income, who is now feeling the pressure because of inflation and because of job insecurity.
Okay, in balancing this, we know that the new leader is no stranger to the housing portfolio. He spent time as the Minister of National Development. What do you think he's going to bring to the table on housing policy?
Well, I guess he's going to look at all the set of measures again, the cooling measures, as to whether this, some have outlived their usefulness. And I don't think he'll rather recalibrate some of these measures. But he has a mind of his own. But a mind of his own, well, that's expected for any leader, and a leader has to have a mind of his own. But if he has a mind of his own, once he made up his decision, then he will likely to stick with those decisions.
Okay, we're also seeing how the luxury market in Singapore in recent years earned a reputation as a place where the ultra-rich foreigners came to park their wealth. We saw a property tax double to 60%, targeting Chinese foreigners. How has that affected demand, if at all? And do you see spillover to other parts of the market?
It has not spilled over to the mass market and mid-tier market. It has affected the luxury segment of the market, in particular, the super luxury segment of the market, something that we at Savills coin as property that is priced $3,000 per square feet and above. That's in Sing dollars. It has affected that severely. But the good thing is that there had not been that many launches of late, and so we don't really see that impact. But on the resale market, transactions for such properties have been ultra thin.
What about when we look further into the future for Singapore and how we gauge public housing demand? I mean, the demographics are also shifting. We're seeing an aging population.
Yes.
On one side, we're also seeing how upward mobility means that first-time home buyers are skipping public housing altogether. They're going into the private market. What's that going to mean for public housing demand?
I think a lot of things need to be relooked at for the public housing market. And the issues of whether is there an overconsumption of housing, whether is property somehow that psyche that property would be the only way to make money, and if you don't buy a property now for your future generations, they will not be able to afford it. Those things I think have to be really erased from the blackboard. I think we have to really look at if public housing is to remain as it is, and population is aging, advised to go deeper into real estate investments may not be the right direction, because as the population ages, they should be liquid. They should be keeping their savings liquid rather than keeping it illiquid. So that narrative about, to sow fear that if you don't buy now for your next generation, they will not be able to afford it, that has to be seriously relooked.
I think the thinking behind that is really what's driven this property boom in Singapore that is defying what we're seeing globally among financial hubs. Do you think Singapore can continue dodging the worst of the property downturn?
Well, Singapore could dodge the property downturn, not only in the residential market and also the office market, but two different sectors, different dynamics. The private market, because of the total debt service ratio, right, and large pools of savings coming from the generation that was born in the 50s to 1990, they have enough savings. And so they could overcome all these issues and of global recession, etc. So that's the reason why we saw demand coming back from the funds stored in the reservoir of savings from the past generations.
Amid all this, though, we keep hearing how the Fed pivot might be delayed. Do you think that's going to affect demand in Singapore?
It will affect demand, but not in the ways that most people think. Many will think that it's because of high interest rates, and so that will hit your mortgage payments, and lower affordability. It's the other way around. Because of the narrative that interest rates are low, why keep your money in the fixed deposit or the saving or other investments when you can buy a property and earn an income, a rental yield, and capital gain? And so, as a result, this high interest rates means less money will be diverted to real estate investments.
Okay, what about the rental market? We saw it surge, especially during the pandemic, and how, after the lifting of curbs, that was a really hot market. Is that in any way affecting the way that Singapore competes for foreign talent?
The foreign talent thing now should be redefined. I think it's in the process of being redefined. Because of generative artificial intelligence, we don't know whether there's any need to actually house that many foreigners or talent in a particular city. They could be working out of home, out of a resort, of any city in the world, and the woke generation will be more of the Gen Zs, the Zoomers, the Alphas in future will be more willing to have that freedom. So rents are coming down, so that's a good thing. And hopefully it would be, that message will spread to the expatriate community who have intentions of coming to Singapore.
All things considered, Singapore's housing model is held up as one of success. What do you think it's going to look like decades from now?
I hope it remains the same. The last thing we want is that private housing converges in the resale market to public housing, and that would have unintended, unimagined, unforeseen consequences, unforeseeable consequences for everyone, including policymakers. Because once you let the open the Pandora's box, you don't know what links to this or that. Right. That makes it more difficult. It's better to keep it simple.
Especially with property very much part of the social fabric in a way of Singapore. Alan, great to chat with you. Thanks so much for sharing your insights. Speaking there with Alan Cheong of Savills. Guys?
Great conversation there, Avril. We'll come back to you soon. Avril Hong, they're joining us out at the Lion City here this morning. And of course, our thanks to Savills there. We're going to be getting more analysis on Singapore's handover of power in the next hour. Bauer Group Asia MD Nidya Now joins us for that.
Yep, and also a reminder, of course, you can sign up for our Singapore edition newsletter for insights into one of Asia's most dynamic economies delivered every week. Check it out on Bloomberg.com. Welcome back. Wow, big news here. China is said to be considering this proposal to have local governments across the country to come in and help out with this problem of unsold homes to ease that supply glut.
Yes, so this is something that we've been talked about since that Politburo meeting sort of addressed it, right? But we're looking for the details. And this is what our sources are telling us, right? That now they're looking to buy millions of unsold homes and seeking feedback in Beijing on this preliminary proposal here so far. And this, of course, we haven't seen that much of any change in sentiment when it comes to the housing sector here as well. For more, let's bring in our team, our Chief North Asia Correspondent, Stephen Ingles, and our China Economy Editor, James Mager. James, I'll start with you. This sounds like a pretty big move and quite an ambitious sort of plan here, if true.
If this was to happen, it's a huge change for how people live in China. It's a huge change for how the government is working with the housing sector, and it's going to mean massive changes not only for how the government works in the economy, but also how people save their money and where they put their investments. So if this does happen and is rolled out across the country, and the governments of various provinces buy millions of homes, I think this is a real sea change in not only the housing crisis that we've seen, but also going forward how the economy works across the country.
Steve, you chime in.
Yeah, I mean, look, if you're reading into the story, you see that this plan, obviously, as Yvonne said, they're seeking consultation from local governments, also banks and government agencies as well. It basically says, according to our sources, local SOEs, state-owned enterprises, would be asked to help purchase unsold homes from distressed developers. So this is not necessarily good news for the distressed developers, except that they're able to get them off their balance sheet, of course, but at steep discounts, according to the story, using loans provided by state banks. Well, okay, I see a couple of big problems. Obviously, we know at the debt levels at the provincial levels have risen to 56% of GDP last year. So there's a huge strain on local government finances. And now you're going to put more pressure on them and more pressure on the banks as well. Their balance sheets are already under pressure. So there's a lot of things to really work out here. And I think that's why it's not necessarily being announced yet. Could take quite some time. But, unsold housing inventories climbed to 3.6 billion square feet last year, the highest since 2016. So it's going to take a lot, according to a lot of money, a lot of fiscal stimulus, if you will, and spending. Tianfeng Securities says it would cost at least 7 trillion yuan, nearly $1 trillion US, or 78% of China's budget deficit this year, for the government to absorb the inventory over the next year and a half. I'm not saying that they're going to do that, but a huge price tag.
Yeah, James, maybe chime in. I mean, 7 trillion, is that something that, in terms of, is that what's really needed to really scale up a program like this and really to clear the housing inventory in China? And do they really have the budget for it?
I mean, I don't know. It's very unclear, like how far across the country this would go. Some places in China don't have an inventory of unsold houses. There are still housing markets here where people still want to move into tier 1 cities and other cities like that. So this seems like a plan that would be more helpful for the poorer places and the less developed places where there has been a massive overbuilding of housing, which was never sold. So whether the whole of this would be, or the whole of the unsold inventory across the country would fall under this scheme if it doesn't happen, where there would just be specific places. I mean, all of that is very, very unclear at this time. But it would require a massive amount of money, as Stephen was saying, if the government was to roll this out. And there's a massive amount of debt that it would have to be taken on to pay for these homes. So how this would be paid, how sustainable is that, and how much demand is there to actually live in these houses as well is another problem, because you can buy all the houses you want in many of these smaller cities. Is there actually people willing to move into those places or not is another question.
Yeah, I was going to ask you that, James. Effectively, if it looks like the headline, effectively it might be a cash transfer to developers. So you address that problem on the developer side, but what does the government then do with all these apartments once they buy them?
I mean, that's a great question. When some places I've been in China, Australia, over the last year, since we reopened from the COVID restrictions, there hasn't been a lot of housing shortfall. There are some places that are still, doing pretty well that people would want to go and live in. And there are other places like cities in Guizhou, where I visited last year, where there is just massive oversupply of housing and there is no demand for those houses. Like, people aren't moving to Guizhou, to smaller towns, to smaller cities in Guizhou, because there's lots of job opportunities and they see a future for themselves there. So they already have this massive oversupply. Who would go and live in those places, even if the housing is cheaper? It's not a cost thing. There's no jobs. There's no reason to go there. So just moving who owns these empty houses from one developer to a state-owned bank or to a local government isn't going to solve the broader problem in these kinds of places.
Yeah, and picking up on that, James, the story indicates that a lot of these units that would be snapped up through those bank loans from state-owned banks or provinces at the direction of the central government would be turned into affordable housing. That's one way to, I guess, get demand. How affordable and where, again, is our key questions. We've already seen cities, Tier 2 cities like Hangzhou and Xi'an already relax all of their property curbs. Whether that is necessarily working to create end demand, we don't know either.
What it really does to the whole supply and demand picture, right? Yeah. Go ahead, James.
I think one interesting thing is how does this affect home sales? Because if you want to, I mean, the secondary housing market is now the largest housing market. It's not new home sales. It's people buying already bought homes. And so people are still going out and buying homes. But if suddenly the government is coming in saying they're going to buy millions of homes and then rent those out cheaply and affordably, what does that do to people's willingness to actually purchase a home? So on the one hand, this may solve the problem of oversupply in some places, but on the other hand, it may damage people's willingness to spend and buy a home, and so therefore damaging the regular property market and pushing prices down even further, which is going to make people who already hold homes unhappier because the value of their asset is continuing to decline. So this may solve the unsold housing problem, but it would actually worsen the home price problem, which is also the government is trying to deal with.
Team, thank you so much. James Mager and Stephen Engel. Just to recap our breaking news, China is experimenting with government purchases of unsold homes. Local governments will be asked, according to the plan here, Yvonne, to purchase unsold homes from distressed developers at steep discounts using loans from the state and then can be converted to affordable housing.
Yeah, we're not seeing a huge movement when it comes to some of these property stocks onshore here today, but certainly, as we talked about, the significance of this is quite huge. But yes, the feasibility question is still very much there on this scoop. We got plenty more ahead. This is Bloomberg.
It's sort of a continuation of the incoherent economic policies of the Biden administration. We've seen this giant push towards green energy over the course of the last several years, and at the same time, a set of policies that run completely contrary to the stated goal of trying to head towards a zero-carbon world.
Citadel's Ken Griffin there at the Qatar Economic Forum on the Biden administration's decision to hike tariffs on some $18 billion of Chinese imports, including the likes of EVs. And those tariffs imposed by the Biden administration are also the focus of Chinese state media this morning. Here's a look at your China brief. There's been an opinion piece in the Global Times saying the U.S. has, quote, no legitimacy in imposing additional tariffs on China. And it cites that WTO rules and calls the tariffs a farce. Now, the editorial says that Washington's accusation of overcapacity is a lie fabricated by the U.S. Another opinion piece in Xinhua says U.S. protectionist moves will backfire on consumers and businesses and accuses politicians in Washington of politicizing economic and trade issues for their own interests.
Now, Xinhua has, well, speaking of Xinhua, also has an interview with Russian President Vladimir Putin, of course, confirmation ahead of his visit to China starting tomorrow. It's a two-day trip. Putin says that their ties are propelling the establishment of a fair, multipolar world order. Now, touching on Beijing's support for Moscow and its war on Ukraine, Putin also says that China clearly understands the roots of the crisis. He also reiterates his praise of Beijing's 12-point proposal to end the war, in which the occupied territories would be left under Russian control. Yeah, certainly this was news which was confirmed yesterday. And just in case you missed it, of course, the Russian president touches down in China from tomorrow for a two-day visit. So May 16 and May 17, of course, keep your eye on more headlines coming through out of that as well.
Yeah, certainly that's the big thing. I still want to talk about this breaking news when it comes to China really considering buying these unsold homes to help alleviate some of the strains that we're seeing across these developers here this morning, and just how significant it is. You take a look at the market reaction. You know, we haven't seen a whole lot, but the currencies are moving here right now. We're seeing some strength crossing through when it comes to the renminbi, the Aussie, some of these proxies as well. But I think, you know, of course, it's short on details of just how much they can scale this program, you know, how feasible it is, how much money is going to be involved to do so. But any signal that there's going to be some property stimulus coming, I think is going to be a positive sign.
Yeah, anything that gets us nearer to a resolution of this, and you know, you underscore a very good point that you know the road ahead is long. They've explored many options along the specific route of how to deal with the excess inventory in the sector, and certainly this is one of the most, I guess, in many ways, when it broke initially, the idea during the State Council was one that really moved the market somewhat. So you talked about yuan, the Aussie dollar. We don't have just yet, I would imagine, things like iron ore, for example, would be one to watch. So the plan would be, in case you missed the news here, and they're seeking they're seeking feedback still here because it's still preliminary. One of the options here is that local state-owned enterprises would then be asked to purchase unsold homes from specifically distressed developers at steep discounts, using money and loans provided by state banks. That's according to two people familiar with the matter.
Yeah. I mean, how they're going to fund this is one thing. Does it change the supply and demand dynamics, right? Maybe it changes the supply, but does it actually encourage people to buy? That's still something that could be that question mark in all of this as well. But there you go. Your CSI 300 real estate, we're up some 2% here right now. We're watching some of these developers are rallying, it seems like, on this Bloomberg Scoop. And certainly we'll wait for more to come when Hong Kong reopens on Thursday and these property developers to react tomorrow. That's it for us here on the China Show. Bloomberg Markets Asia is next.